Hey everyone, Michael here. This is going to be a very brief video about how I size and position size, and then also determine the strikes for the earnings Iron Condors. I've had a couple of questions via email, private message, so wanted to get this out. I'm going to put it as a message or as a response to the latest post of Green Goose Trader. Also, probably will be putting this as just a general instruction for all new premium subscribers. Anyway, this last, I believe it was Wednesday, 27th. Yeah, last Wednesday, one of the plays was Lamb Research, LRCX, which was going to reporting earnings after market close on Wednesday the 27th. This is one of the names that I like to play. It has generally very good success, and had I think it was like 4 out of the past 4 successes playing in earnings Iron Condor. So the following is an earnings Iron Condor. I'm using Tom's option tools. If you got this is a really good way to look at things right around the 340 mark to see where things are sitting. And then verifying with your broker as far as where strikes currently sit. The way I design an Iron Condor over earnings play, which is basically it's a 24-hour play, where I enter right before close, or as maybe the last 15 minutes before close, and then I exit the last 15 minutes of the open the following day. After earnings. So LRCX, I just pull up the options chain for the closest expiry. And what I do is I take a look at where the price is trading at that moment. I look at my broker as well. This kind of gives me a general feel. And the price at the close was 267.66. Actually, I was trading a little bit higher than that just before it closed. So 467.66. So the closest at the money straddle is 467.50. So I take a look at the premium of that straddle, which is 1130 mid price plus 1140 mid price, roughly $23, and I subtract $23 from this price here. So I just rounded up to 470 minus 23, and that allows me to place my strike at 445 as far as a short strike, and then I protect it with the next lower strike, which is right here. So, and then I do that on one side with puts. You can either enter the puts in one order, and then the calls in another order, or you can enter both at the same time as an Iron Condor. In the case of LRCX, I actually entered the calls first. At the time it was trading, the $23 actually equaled the $495. But in this particular case, 23 plus 67.68 is $490. So you would normally place it right here. 1. Okay. I ended up getting the 495.500 because at the time when I placed it, that's where it was. And then I placed the other one, the puts, right after that, and I got filled at 445, 440. Anyway, so this sets you up for your Iron Condor. I verify it with my broker, make sure it's right, and I'll place my orders accordingly. And what happens is you see that you get into an Iron Condor where you're selling an out-of-the-money put, selling it out of the money call, and you're protecting it with a strike outside. Okay, so as far as position sizing, normally I like to position size these things to about $250. When you get a higher price stock, it's tough to do that, especially if you're $5 wide in your Iron Condor as far as your short and your protective leg. So my max risk on this is $344. So I only do one contract. If I'm doing something like PFE, which was also a play last week, I was able to get into 3 contracts for the risk of $250 or less. Okay, so what happens with these is the volatility crushes over earnings. And if the stock doesn't move, then it drives these curves inward. Okay, you get rid of your implied volatility, and the theta kicks in as far as time decay, and you're able to buy these things back in 24 hours for much less than you actually sold them for, and that's profit. So in the case of LRCX, you can see that actually I was able to buy it back. I can't remember exactly how much I got, but I was able to buy it back. So the profit on this particular one was $82. These are lots of chip shots, lots of putts, but they add up, and they add up really quickly. Usually I get about $2,000 per earnings season with all the different plays. Okay, so sometimes they don't work, but that's just the way it is. But so LRCX didn't move enough, still stayed within this. And what happens is the volatility crushed. It brought profit in, and usually I'd say 95% of the cases, I'll just close the sucker out the next day. If we don't move at all and we're still really right in the middle, sometimes I'll actually take it to expiry if there's just one day left. Like I said, Thursday and I go to Friday, but the best way to do this is just to close it out. So what you do is you buy it back, okay? And you can evaluate whether you buy both sides or just one side. In the case of LRCX, it really doesn't make much sense to buy back the put side. You can just let those expire. So what you do is you buy back the call side only. So I'll just force it here, but just let me save it. And obviously, your broker is going to look a little bit different. But the way I do that here, just showing it, is I close one side. I close the call side. One. And you then are left with basically a bull put credit spread, but with 1 day to expiry. You do have to take on a little extra risk, but the risk is really low because if it's gone up that far, it's pretty unlikely it's going to go way back down to close out here. So then you just you take it to expiry. For example, in this particular one, you take it and the lower leg expires worthless, and essentially you have $87 profit on this particular one. Okay, that 78 is not correct. It's just the way things work out. And Tom's, your broker, would just basically say, okay, these two expired worthless, and you keep all of the credit. Your margin or your max risk goes away at that point. So just one other example, just so you can see how I do it. PFE was another one last week, and PFE, I believe, reported before market open. So the way you set up your Iron Condor on this one is you take a look at what the close price is, $51.95. So you're close to close. It's $52. So you take a look at the 52, you take $1.13 plus 69. It's just about $2. You actually do plus and minus 2. So 52 minus 2 is 50. You place it there. I don't like halvesies, so I usually go with $1 wide. And then you do 52 plus 2, it's 54. -1. And again, halvesies I don't like. And 1. Okay, so, and this gives you the ideal. And so your Iron Condor in this case is $24 credit versus 76 risk. To get up to $250 risk, I can do 3 contracts. Oops, 3. And then you can see that my max profit is $72 on 220 risk, 228 risk. I want volatility crush and no movement. And PFE moved a little bit on earnings, but it ended up at the end of the day right smack dab in the middle. Okay, so at that point, what you do is you just close it out. Again, in this particular one, I'd be looking at probably closing the whole thing. So what you're doing is you're buying it back. You can take these all the way to expiry if you think there's not a lot of risk of it actually going outside of these wings. So just kind of give an example. What happened with PFE is it really went nowhere, and the stock ended up closing above your basically above your short strikes. So full profit. So it's just an examples of how I deal with it. You've seen in the Green Goose Trader post the opportunities of the coming week. This is exactly how I do it. First, I go into Tom's, then I go look at my broker, verify it out, put the entry in. So when I put out an alert on what strikes I'm looking at, I'm just looking at those at that point. And usually it'll get confirmed out right around quarter to 10 to the hour. So hopefully this is useful. And please let me know if you have any questions. Thanks.